Hello, everybody, and welcome to today's Savant Live webinar. Thank you so much for joining us to discuss building confidence in your financial future. My name is Evan Goldfuss, and I am a financial advisor in Savant's Atlanta office. I've been in the industry for about 6 years, and I'm very excited to discuss the topic today with my good friend and fellow financial advisor, Steve Lorence. Welcome, Steve.
Hi, Evan. Thank you for having me today. I'm glad to be here. As Evan mentioned, my name is Steve Lorence. I'm a financial advisor here at Savant Wealth Management. I'm based out of our Rockford, Illinois office, and I've been in the industry for about 11 years now. I'm really looking forward to today's webinar. It's one of my favorite topics to discuss. So go over the agenda real quick. We're going to be covering a variety of topics here and kind of going in order as far as, how we view them, right? So we want to talk about crafting your ideal future and what that means, right? And that's going to mean something different for everyone. We also want to discuss understanding your current situation, right? In order to know if where you want to go is a reasonable expectation, we need to know where you're at today. With that, we need to come up with an investment plan, right? We want to take a long-term view of investing. So we're going to discuss investing for the long term and what that means. And then certainly once you accumulate your wealth, it's really important to keep it, right? It's not about what you earn, it's what you keep. So we're going to discuss throughout most of the presentation how to build your wealth. And then we'll mention a few things here at the end about how to protect that wealth.
All right, so let's start at the beginning and really start that conversation about crafting your ideal future. So, want to start today's webinar with a quick little exercise. Start basically at the end, really, to kind of understand how to best plan for, the road ahead. So, quick little thought exercise. It's Valentine's Day. Let's go ahead and get into our feelings here and really start thinking about some things. Want to do a short little exercise, and on your own, please look back. Think about this. Looking back, what are 3 things on your 90th birthday that you would like to look back and say about your life's achievements? Okay, it's a very deep question. It's a very broad question, not super specific. Everybody's going to have a little bit of a different answer. There's no wrong answers here. In fact, the only wrong answer is I'm not going to live to 90 because you got to be able to plan for those. People are living longer. We definitely have to plan for, that far out, but really start thinking about, what you would like to say about your life at that point in time, looking back. So like I said, there's no wrong answers here. A few common ones we usually get are, I want to, travel the world, lead my life with adventure, leave no stone unturned. I want to provide for my family and create the best life possible for them. I want to leave a legacy, make an impact, leave the world in a better place than I found it. Things along that nature, right? So start thinking about these really kind of broad questions here. And when you think about these questions, most people, as we come, going through our financial lives, these broader questions start to get really cemented in as we come upon retirement. We've gone throughout our entire lives, really focused on our careers, creating wealth, providing for our families. And then we come upon retirement and we start to take a step back. There's a major, tremendous, transition. And all of a sudden you take a look at yourself and you say, okay, well, now I've got this next section of my life. What do I want to do with it? What are the decisions I want to make today to, hopefully provide a great 90th birthday looking back to tomorrow? So a couple things. Oh, sorry, were you going to say some, Steve?
No, yeah, I was just going to say, when you think about these things too, a lot of people think of their financial goals in the context of I want to retire in 3 years. I want to buy a second home. I want to do these things. This is a great opportunity to think about, what do you want to leave behind? What type of legacy do you want to leave? Is education really important, both for your family and maybe other people? What other type of things on a broader level, right? Maybe not those granular details of I want to buy my dream car or I want to, buy a house here, right? Think of maybe some of those bigger things that can encompass all aspects of your life.
Right. Yeah. So maybe a great dinner time conversation at Valentine's Day dinner tonight with you and your spouse or your partner. So as we kind of think about these broader ideas, we can start to think about, like we said, as we come upon retirement, what are some of the things that we want to include in retirement? What are some of the actions, the goals that are going to build up and create that, successful path to ultimately to that 90th birthday, right? So when thinking about coming upon retirement, what kind of lifestyle do you really want? What do you want to be included in there and be checking off in the boxes? A lot of time will love, or a lot of people will like to include, part-time work and volunteering, oftentimes to kind of ease that transition from just going from working full time to going into retirement, maybe dipping your toe in one step at a time. A lot of people will throw themselves into travel. Like I said, just getting that adventure out. You have all the time in the world to do it now. Relocating, maybe making a major shift in your life, or exploring new hobbies and passions, and really, as we kind of said before, or directing that passion and that focus back onto yourself rather than your career. So, again, encourage you to start thinking about all of these action items and goals, because as the more we start to put this pen to the paper and start to lay out what these goals are that are going to create that ideal future, we can start to really create a much clearer vision of retirement, right? What all is going to be included in there, and what all is going to be, again, included in my clear vision of my ideal future. I always love bringing up a great quote from Yogi Berra. I don't know if you guys have heard of him, famous baseball player. He was really famous for a lot of his kind of one-off quotes called Yogiisms at the time. But one of my favorites from his is that, if you don't know where you are, if you don't know where you're going, you might end up somewhere else, right? And so take a step back and really think about what that means. If we don't really understand where we are and where we want to go, we could end up someplace totally different that we really didn't intend to do. And that's really the last thing we want to do at the end of the day, right? So it's all about really putting the pen to the paper today, creating those goals and understanding what your true retirement wants to look like. And then from there, you can start to identify what actions and steps you need to take in order to get yourself on that path.
Awesome. And yeah, then that's exactly right. You need to know where you're going in order to plan for it. I always tell people, and probably people get sick of me hearing it, but you don't end up accidentally accomplishing your goals, right? You need to know what goals you want to accomplish in order to back into what do you need to do today, and are those goals reasonable? So this is a really important step that I think a lot of people maybe discount. They know they want to retire, but they really haven't thought about what that necessarily means for all the other aspects of your life. I always tell people it's really hard to replace 40 to 60 hours a week that you spent working, right? So it is something that you really want to spend some time addressing and thinking about to make sure that you're doing the appropriate planning to get to where you want to be.
Right. And so as we talk about doing the appropriate planning and kind of breaking down what those strategies look like, it's the same as creating a plan for really anything else in your life. When it comes to goal setting, you got to have a vision. So you got to understand what your future looks like. You got to understand what your goals are so you can map out the steps to support that vision. And then you need to understand when and what you need to take action on. What are you prioritizing, in that list of accomplishments and achievements? And what does that timeline look like for each one of those, achievements and accomplishments that you want to include in your ideal future? So it's all about, they always say a good plan today is better than a perfect plan tomorrow. So, there's never too early of a time to start thinking about this, no matter where you are in your journey to retirement, whether you're, on its doorstep this year, or if you're, 5-10 years out. There's no better time than today to start really thinking about this and planning. And so if there's one thing we know, with everybody on this webinar, everybody's going to be at a different stage, in their life and in their financial journey. If there's one thing we know, no two people's paths are going to look the same. But what I can promise you is that everybody's path is going to include a lot of twists and turns, wrong directions, 2 steps forward, 1 step back. Everybody's life is going to come with different changes, and everybody's plan is going to change over time as different obstacles and challenges come up. So a lot of different challenges and common ones that come up, throughout our financial lifetimes are going to be, dealing with debt, dealing with the increase in healthcare costs, different, conflicting financial values with people, either in your family, your spouse, people you care about, saving for rising costs of college, retirement, And then again, just planning for all those different needs, wants, and wishes that everybody's going to have different, ideals for in their future. So, like I said, if there's one thing we can, count on is that life is going to be changing. It's going to be a winding road, but the more we can do to outline a clear vision today, the more we can start to plan and identify the actions and tools that are going to keep us on that road, right? So we know it's not going to be a straight line highway. It's going to be a curvy, winding road, but we still got to stay on the road and stay within the guardrails. So the more we can do to identify, how to best do that, the better off we're going to be understanding what our blind spots are, dealing with these challenges and conflicts, and ultimately just providing ourselves more flexibility. And with more flexibility comes more control over your decisions and what you want to do. So getting out in front of everything is absolutely crucial. And you'll see that a common theme of today is that time is going to be your best friend. So we want to get out ahead of planning for really what we want on the road ahead.
Awesome. And I think, just kind of before we move on, Evan, you pointed out a good point, right? It's about building in flexibility into your plan, right? There's all the things that you mentioned. You want to set your own goals. And then there's the things that we see here on this roadmap that you just have to plan for. Some of them may be outliers. Some of them may not be, relevant to every single one of us. But we do, people experience changes in their life, and you want to plan for those specific goals, but you also want to account for those things that are just going to happen that we can't count on when they're going to happen. We can't count for how much they're going to happen, but we want to include something in the plan. And those are those things that we see on this roadmap here. The next step of planning, once you understand where you want to go, is taking or understanding where you're at currently, right? That's super important. It's important to understand where your assets are, what assets you have, what are your income sources, all of these different things, because that's going to determine how successful your plan is, right? You need to know some of these variables or all of these variables to be able to understand, are my goals reasonable, right? And it's going to vary for everyone. Somebody who has X amount of dollars and wants to spend $60,000 is in a completely different situation than another person who wants to spend $200,000 in their retirement, right? Those are two completely different goals to plan for. They both may be reasonable given a set of circumstances, but you need to understand where you're at today to determine whether your goals are reasonable. You want to make it a process, right? You don't want to just wander willy-nilly, right? It's great that we have Google Maps. I remember back in the day, we used to use MapQuest and print those out, right? But you wanted to have instructions and you wanted to have steps to take in order to get where you wanted to go. And it's no different in financial planning. You can kind of drift and wander and maybe end up where you want to be or close to where you want to be. But it's much better to take a disciplined approach, right? So we always start with determining what's important. That's going to be those goals that we were talking about. What's important to you? Everyone's going to have something different that's important to them, right? Some people want their last check to bounce. Other people want to leave each of their children $1 million, right? So those are two things, two completely different ends of the spectrum, and there's no right or wrong, right? It's about what's important to you. You then need to perform an assessment of your current plan. And that current plan may be no plan at all, right? And then you also want to take a look at your portfolio and your different retirement income sources. Some of us may have pensions, or most of us, right, are going to get Social Security unless there's something unique that stops, if you have a government pension or whatever it may be. The next step then would be to develop that plan, right? So you set where you want to go, you assess your current situation, and you determine how you could bridge the gap, right? That's really developing that plan on how to get where you want to go. After that, you got to implement and coordinate that. And then you want to review it, right? If you're sailing across the Atlantic Ocean and it's windy out, you want to be checking your course consistently, right? You don't want to be waiting every day, 2 days, 3 days a week and find out that you're 2 miles off course, because that's going to take a lot of course corrections, can be a lot of time, and it may not be that enjoyable, right? We want to make sure that we're checking our course consistently over time, because the minute you put a plan together, the assumptions change. You get different return than you were expecting. You're spending, a big expense comes up that you weren't expecting at this time. And all those things change. So we need to make sure that we're correcting our course along the way. So this really lays out the different steps to the financial planning process. And we'll, kind of sit here on number 2 and talk about what that means for individuals. So as I mentioned, right, you want to take an inventory of your current assets and create a net worth statement for yourself. This is going to be like a company's balance sheet, right? What assets do you have? What assets are liquid assets? What assets are fixed assets, such as your home? What assets are retirement specific, right? We want to categorize that and break it down and see what resources are going to be available to accomplish those goals that we discussed in section 1. Right? We need to know what resources we have. Another crucial thing to do, regardless of where you're at in your retirement planning journey, whether you're 35, 40, 50, 65, 70, it's really important for us to understand what we're spending, because that's going to facilitate, again, how reasonable our goals are relative to our asset values. It's also going to facilitate what strategies may make sense for you longer term. So it's crucial that you understand how much you're spending. Some people are going to be really granular. They're going to know how much they're going to spend at the beginning of the year, and they'll be within a couple $100s at the end of the year because they're very granular. Other people say, I save off the top, I spend the rest. I don't know what exactly that number is. So it's really, really important to know what that spending number is, both before retirement and in retirement. Again, there's a big difference in between planning, thinking that it only costs you $80,000 to spend to live your life. And if that's the number where you're using, you're going to come up with a completely different number of how much money you need. And if you end up spending 120,000 because you weren't accounting for things in your budget, that's going to be really, really hard on your plan, and it will probably facilitate some necessary changes along the way to make that realistic. So crucially important to understand what your spending is, or at least have a ballpark of that, right? You don't necessarily need to track every individual item, but if you could look in categories, I always recommend that people, whether through their bank account or whether their credit card statement, that's usually a good place to start. Most credit card companies or banks will offer a breakdown of your spending monthly and annually. It may not be perfect, but at least it's a good start and will get you in the ballpark. Budget worksheet, that's another great tool. There's plenty available. Savant uses a budget worksheet. There are free budget worksheets out there. And it's a great way for you to really spend some time, whether it be by yourself, whether it be with your spouse, significant other, whoever it may be, to sit down, have dinner, maybe not on Valentine's Day, they may not appreciate that, and go through your expenses and really see what does it cost you to live your life today, and outline what expenses will either decrease or increase in retirement. I always say, what's the most expensive day of the week? For most people, that's going to be a Saturday. Well, when you're retired, every day is a Saturday. So you want to account for the things that you're going to happen more often. Dining out, travel is usually one that increases, and there are other things that will likely decrease. Hopefully, when you're in retirement, your kids, grandkids, hopefully they're off the payroll. If not, though, you want to account for that. You may go into retirement without a mortgage. You may pay that off pre-retirement. So that's an expense that's going to go down that you need to highlight, because that does affect numbers and does affect the overall budget, whether that's in there or not. So those are just some things to consider as you sit down and go through your own budget that some people might forget.
Yeah, and I just want to say on that one, Steve, not only is this an important exercise, one, to just identify where most of your spending is going towards and really help you hone in on what that savings number needs to be. But also, too, it's always healthy to kind of go back over your budget, ever so often throughout the year to kind of see where things are maybe falling off the radar. As we all know, life gets complex. Sometimes you end up with multiple subscriptions to, Hulu, Netflix, anything like that you may not be using. So oftentimes, not constantly, but consistently going through your budget can maybe help you identify some things that you could probably shave off of your budget that can immediately go back into your savings.
Absolutely. Great point. So again, with creating a budget, if you're significantly pre-retirement or whether you're getting close to retirement, it allows you to start allocating the resources that you have today. If you make, just as an example, $100,000 a year, and you know that you need $60,000 a year for all of your expenses, then we know that we have roughly $40,000 net some taxes to prioritize what's going to be important in order to feed into your goals. Again, if you know what your goals are, you could start prioritizing today to determine what you need to do to better enhance your plan. And that may be prioritizing high interest debt, right? I mentioned a mortgage before. Not all debt's created equal. I think most of us would agree with that. A mortgage, especially if you locked it in pre-2020 or back when interest rates were really low, that may not be bad debt to take into retirement. But credit card debt, credit card debt can tell you a lot about your spending, right? It's bad debt to have because it's really high interest rate. And typically, if we have credit card debt, that means that we're probably not super accurate with what our budget actually is, right? So that's a good way to identify, is your budget realistic, or is there maybe some adjustments that need to be made to get it in the ballpark of where we want it. Along with that, you could determine, are we going to be making extra payments on that debt, right? Do we need to negotiate lower rates? How do we avoid new debt into the future? If you don't have debt, right, it could mean, where are we going to save these extra funds? Or when we pay off this debt, how are we going to position these funds in a way that's going to help us better accomplish our retirement goals? As I mentioned at the very beginning, we want to take an assessment of everything, right? Not just our debt. We want to take a look at all of, or as many of the factors as we can think of in order to build that plan, and we want to build that into the plan, right? Your spending in retirement, that's going to be a huge driver. Most people don't consider it, but the average person could be retired for 25, 30, 35 years, right? That's a long period of time. Most of us are probably work for our career for 30 to 35 years, right? So there's a potential that your retirement years are just as long as your working years, right? So that spending is going to be critical. With that is withdrawals, right? In particular, the percentage of withdrawals as it relates to your investable asset base. That's going to be super important. That's a good litmus test as far as whether that plan is reasonable or not. If you have a really high withdrawal rate relative to your asset base, that's going to make your money work really hard. And if timing isn't great, it may end up forcing you to have to make changes, right? So talking about what that withdrawal rate looks like and what's reasonable for you. In particular, when you factor it in with things like Social Security and a pension, right? Speaking of pensions, what's the solvency of the different secure or the different fixed income sources that you have? Social Security, pension. Social Security, we hear about it all the time, right? That's something that people are concerned about. So do we want to include that in our plan for 20, 30, 40 years from now? Or do we want to exclude it and make sure that we're going to be okay regardless of whether we have Social Security, right? Pensions, not all pensions are created equal, right? Some people have private pensions, other people have public pensions. And there's a wide variety of how solvent those pensions are. Some of them are super well funded and they have a really high likelihood of continuing on into the future. Other pensions are a little tighter, and there's a decent chance that you're going to see an adjustment to the benefits at some point over the course of that pension. So it's really really important to understand what those risks are. You want to understand market volatility and what effect that has on your portfolio and what effect that has on your income in retirement, right? Are you able to experience a 20, 25% downturn in the markets like we did in 2022 and still retire and be able to accomplish your retirement goals, right? We want to understand that. Inflation's going to be a big factor, right? We know inflation can erode savings. We've heard about inflation pretty constantly over the past few years here. So how is that going to affect savings, right? Or how is it going to affect your spending in the future? We know a dollar today is not equal to a dollar 20 years from now. So how many dollars in today's dollars do you need to spend tomorrow's dollars, right? That's a big question. That's a question that everyone should really understand. And then again, that longevity. right? Understanding what longevity risk plays or how that plays a role into your plan. Some of us have longevity in our family. We all know somebody who's both of their grandparents lived to 95. Their parents are, 80 and still super healthy. You would never guess. And other people, they don't have longevity in their family. So that's a discussion you want to have. It's something that you don't necessarily want to plan for some changes in longevity, right? You'd probably want to plan for longer longevity, but it's something that does play a significant role in your planning process. Again, setting a goal for consumption, right? This kind of goes back to stage one. You need to set that goal for consumption, and you need to really understand how realistic that goal is for you, right? You want to be honest with yourself about how much you're spending today, because that's going to directly drive the viability of your plan long term based on the assets that you want to achieve. Again, using my example, if you think you're spending $60,000 and you're actually spending $80,000, those mean two completely different numbers as far as how much money you need to have at your retirement date in order to reliably accomplish your retirement goals. And you want to test this, right? You want to stress test this. You don't want to just assume linear assumptions, right? You don't want to just assume that you get a certain percent return over time. You don't want to just assume that you have great markets coming out of the gates in retirement and everything's going to be Goldilocks and rosy, right? We want to make sure we're stress testing the plan. So in my example, we want to know if the markets drop 25%, what's our percent chance of success of being able to still accomplish our retirement goals? Again, this is kind of going the same thing and kind of outlining some of the things you want to consider, right? Some people need less money than they had or less money than they were earning, right? Well, they were in their working years. Some people are going to need, significantly more, right? If you're going to be buying a second home, if you plan on traveling a lot, if you're going to be helping pay for grandkids' college, if you're still paying for your own kids' college or helping support them, right? It may mean that you need 100% of your current income, or it may mean you need 110 or 120%. If you're in a different situation, your mortgage is paid off, you're not big travelers, you just don't have a lot of expenses. Maybe you spend a lot of time at home reading, or maybe you have a property that you like spending time at that it doesn't cost a lot of money on your day-to-day living. In that case, you may need significantly less than 100%. But again, super important to know this number. Out of anything we talk about today, for everyone, this is be the one thing that I would want you to go home, sit and do some homework with, and think about how much are we spending today? How much would we like to be spending? Are we spending money on everything we want to be in retirement? And get a good handle on what that number looks like, or what you want that number to look like. Again, reviewing the income sources. It's one thing to understand how much you want to spend. It's another thing to determine whether that's a reasonable spend rate or not, right? And all these things are going to play into income. We're going to have Social Security. Some of us will have pensions. Other people out here may be selling a business and trying to determine how they're going to turn that business that was their income source for all those years into an income source in retirement when it's no longer earning revenue from customers, right? And then we're also going to have investment withdrawals, right? A lot of people, that's going to be the primary source of their income in retirement. And so we need to really understand what those investment draws are going to be and whether that's a reasonable withdrawal rate, kind of going back to a previous slide, given our asset base. Again, other sources of retirement income, you want to include your savings here. You're going to include your 401k, 403b, 457s, your employer plans. You're going to include your outside of your employer plans, your brokerage, your IRAs, if you have a business. You're going to include Social Security, pension, maybe some rental income. As Evan mentioned earlier, right? If you have part-time income, right? Maybe we're just scaling into retirement and we're still going to have some income along the way. All those things, super important.
Yeah, and I think it is really important to do that exercise. The more you can fine tune those numbers and really understand what's going to be going out and what's going to be coming in retirement, we can really start to identify, as we build up our savings and our investment accounts, that's what's going to come into play to kind of fill that gap between what's going out the door and what's coming in from income. Once we can understand what that gap needs to be based on our spending, we can understand how to build our portfolio to support and properly fill that gap. So yeah, we can jump into the next section and really talk about, you know, one of the greatest partners that is going to be with us throughout this financial journey, and that's going to be dealing with the market, right? So as we think about the market, it is so crucial to understand and take a long-term approach with how you want to approach investing, right? As we said, we need to be able to plan for a very long period in retirement. People are living longer. We're talking life expectancies, above and beyond 95 years old. I think a lot of people also kind of get so fixated on, that period leading up to retirement. You're saving, you're building your investments, but you have to understand some of the most crucial years of dealing with the market are going to come in retirement. You come up on your retirement date, it's not, you're not done dealing with the market. In fact, it's going to be one of the most powerful allies you're going to have in keeping your nest egg growing and sustaining what you need to be spending from it.
No, absolutely. And I'll just kind of step in and try to paint a picture here, right? We like to talk a lot in analogies. And when it comes to financial planning in particular, investments are what get a lot of the attention. But we like to equate financial planning to like going on a road trip. Again, we need to set goals, we need to know where we're going, but we also need a car and we need fuel for that car, right? Your investment return is going to be the fuel for that car. And you want to make sure that you have the right fuel in your engine. If you drive a diesel truck, you want to put diesel in that engine. If you drive a gas car, you want to put the right gas in there. Again, if you have an electric vehicle, you want to charge that. And when it comes to investments, there's always two factors that comes into it. There's going to be how much return do you need and how much return can you tolerate, right? Or how much risk can you tolerate, that is, because those are going to be correlated, as Evan will talk about.
Yeah, absolutely. So I think in order to identify, like Steve said, what kind of gas do we need, what kind of gas do we need in the car, and what kind of car are we driving? You kind of got to start at the beginning. So let's understand really, when we look at the stock market, we have to take a long-term historical approach. So go back and look at, really the last 100 years of data, going back all the way to 1926. This graph actually doesn't even do it justice, basically showing you the returns of the different areas of the stock market. It's based, you'll notice it's kind of based on a log scale there. But to really see, okay, how powerful markets are in, adding, wealth and growth to portfolios over a long period of time. One of the things that'll jump out as you look at this graph is that those two kind of top lines, that small cap stocks and large cap stocks, are well above that bottom red line, inflation. So as we talked about, everybody's feeling the effects of inflation right now. We're feeling it in real time, just what inflation can do to the purchasing power of our dollar. So, dealing with the markets is something we have to do because we need investment returns and growth of our investment assets in order to outpace inflation and retain purchasing power of our money, right? So we have to be able to kind of dance this dance with the market and understand what kind of risk and return we need to sustain that withdrawal rate in retirement, right? So let's talk about, it's so important to take a long-term approach, right? If you want to harness the power of these markets and not have them work against you, you want to work with them, right? So we have to be able to make the right investment decisions. You're going to hear me say this a few more times today, but we are such firm believers when it comes to dealing with the markets that planning has to drive your strategy, right? It can't be the other way around. We can't approach the markets and investments first without knowing what our plan is and what we need from the market and those investments. Right. So let's take a look at basically two ways to really think about approaching the market. We know that it's a very powerful tool for long-term investors that want to harness the power of the markets, right? But what is the best way to really capture those returns we were just seeing on that last slide? What's the best way to go about this? So when you take a look at, again, historical approaches, there really are two main schools of thought, right? The first one on the left there, conventional investor. You might, kind of hear this as the active, stock picker type investor. This strategy is going to be taking the more emotional based, I would say, emotional based strategy towards the stock market, right? They're trying to engage, this kind of investor is trying to engage in market timing. They want to try to beat the market, right? They're trying to jump in and out of asset classes, different areas of the market in order to outperform the broader market. They're making their decisions, like we said, not necessarily based on data, but rather based on emotion, what they're seeing in the headlines, what the talking heads are saying on the news. They're not taking a fundamental long-term approach. They are more focused in on the day-to-day, the month-to-month, even the year-to-year. And I know that sounds crazy that, a year is such a long time, but when it comes to the market, it really isn't. It's a very short window. So the other school of thought that, again, once people realize that that first method of approaching investing is really hard to do, it's not a really repeatable strategy to win and beat the market year after year. People were kind of fed up of having those big misses, right? So, there was born a kind of a new approach to how to approach the stock market. And again, this is really partnering with it, trying to harness the power of it rather than try to fight against it or try to beat it. So, we call this evidence-based investing. And really what this is instead of taking an emotional approach, it's a data-driven approach. You look at the long-term historical trends, the long-term historical data, where returns are coming from over those periods of time, and you structure a portfolio based on where those returns are coming from, based on a much more diversified strategy that's not trying to jump in and out of different asset classes, but rather is trying to capture the benefits of all of them, throughout the lifetime of our investing. It focuses more so on what you can really control in a portfolio. We don't know what the market is going to do day to day, month to month, even year to year. But what we do know is that we can control certain aspects of it, such as how we're invested, how we're diversified, how much we rebalance and realign with our strategy. Like Steve said, it's kind of like driving a boat. If you drift off course, you have to be able to course correct, right? Where rebalancing comes in, and really just looking at the overarching evidence, like we said, of where returns are really coming from in the market. So if we take a look on this next slide on, historical times and what has happened in each areas of the market, it basically looks at a bunch of different asset classes. And we like to call this, grandma's quilt. There's not too much of a pattern going on here. And as you can see, this basically shows calendar year after calendar year where returns were strongest and weakest in different areas of the market, right? This is a really heavy conversation that is on the minds of a lot of people today, as we said, as we're seeing things on the news, like those really big, tech stock names, Google, NVIDIA, Amazon, all those are really capturing all the headlines and kind of attracting investors' attention. But it's important to, again, take that long-term perspective approach and look at what has happened in history and really approach the market with, a vision and strategy of diversification. So if we look at all the different asset classes, you'll kind of notice on the top there that US large cap stock in that dark blue. Been one of the top performers over the last couple calendar years, right? And, as we said, even looking at the market on just 1 year, even 5 years is a pretty short time period. A lot of people are focused in trying to chase those returns in certain asset classes and concentrating their portfolios in just one thing, instead of spreading it out and understanding that these things are going to change over time and we don't know where and when those returns are going to come from. So having diversification and exposure to not just all different sizes of stocks, but all different types, growth and value, and then even all different countries, right? We don't want to just be invested in just those US stocks, even though they have done well over the past couple years. In fact, you only have to go back another 10 years to remember that from 2000 to about 2009, the return on the S&P 500 was pretty much flat from the dot-com bubble that we had in 2000 all the way until the recession in 2008 and 9. So, people tend to have a very, short-term memory, I think, when it comes to the markets. And so the further we can zoom out and really understand that it's so important to have all these different areas, in our portfolios, the better off we're going to be when it comes back to, that portfolio providing us that sustainable withdrawal rate. We want to minimize, as Steve had said, minimize the volatility, minimize the downturns, especially as we're coming up on retirement, because we don't need to be taking extreme risk and having, 40, 50% drawdowns that are going to blow up the rest of our financial plan. We want to spread out our money and really harness what is happening across the globe, not just in one area, right?
Yeah.
So, oh, go ahead, Steve.
Oh, and I was just going to say, and that's exactly the point. You have to remember the why, the why where you're diversifying again, and you hit it right on the head. It's about increasing the likelihood that you're able to accomplish your goals and remove the variance that you don't. Right.
Right.
So again, it's when you're young, you have time in front of you. That time is going to be your risk mitigator. Right. Yeah. Yeah. The farther out you are from retirement, the less risk or the more flexibility and opportunity you have to make adjustments in order to be able to retire when you want to. When you're in retirement, you don't have that time anymore. So it is really crucial to look at risk adjusted return and removing that risk. Again, just because
Right.
one thing does well over a couple of years, that doesn't mean there's not risk within that asset class. And we need to acknowledge that, because when things are going good, sometimes it's easy to forget that risk exists in a specific pocket of the market, but it will happen. There are times in history. We saw it in 08, 09. We saw it in 2000, right? We've seen it in periods of time in history where there's a big drawdown in, asset classes across the globe, maybe bigger in specific markets. So it is important, again, to remember the why. Why are we doing this? And it's not necessarily about just maximizing long-term return. It's about maximizing risk-adjusted return over time.
Right. So, the overarching theme, as we said today, planning needs to drive strategy, and you need to take a long-term approach and really just tune out the noise of, oh, you can go to the next one, Steve. Sorry. So, and really just tune out the noise of what's going on in the background. As we said, and as we showed on that last slide, we just don't know when returns are going to happen. We don't know when these corrections and downturns are going to happen. But if there's one thing that history has told us, is that the market has continued to press on over time, right? If you go back and look at all of these different headlines that we've seen, since 1999, there's been a lot of big headlines and a lot of scares out there that have really, struck fear into investors and made them change decisions, maybe that their plan didn't need to do. But we've made it through each one of these headlines. If you would have gone back to 2007 and seen what was going down there, nobody wanted to invest in the market. But had you stayed put and stayed on your plan, you would have continued on and pressed up even further. I mean, since then, the cumulative total return over 300%. So a lot of times what we don't want to do is get emotional and make a bad decision at the wrong time. Okay, that's what really derails financial plans and puts us, as we said, in a place where we can't be flexible and where our plan is more going to be in control of us than we are in control of it. That's what we want to avoid. So again, tune out the noise, focus on the things that you really can control and what matters, right? So that's creating an investment plan that really fits your needs and what you're trying to do in retirement. Focus on your diversification, manage your expenses and your taxes, keep things as low cost as possible, and stay disciplined. It's so important to stay on that strategy. Understand where you are, understand as you stress test your plan, know what, you have in place to be able to get through those hard times and weather the storm so that you can stay on the path that you need to be on. So,
Yeah. And it's important to your point, Evan, right? It's the disciplined approach. You hear it all. We've all heard it. Everyone's heard it, right? I lost half my money in the 0809 financial crisis, right? And it's important to remember, and this chart's crucially important, why it's important to stay disciplined.
right,
Because you only lost if you sold your assets at that time, right? If you let the market work for you, I always say it's the best employee that you have. It never has to take breaks. You don't have to feed it, you don't have to pay it benefits, and it's always working, right? It's working around the clock. And this, again, this is showing why you stay invested, because no matter how bad it feels, to your point, Evan, in the 6 months, in the 12 months, in our 24-hour news cycle, there's always going to be something scary.
right.
But the markets are still working in the background. There's still hundreds and thousands of companies out there that are working hard to try to make money. And this,
Yes.
I think this is a really good picture of that.
Yeah, and just remember, those talking heads, everybody on the news, is not there to help your financial plan. They don't know you. They don't know your goals. they're there to keep eyeballs on the television, and so they're going to say whatever they can to keep you glued to it. And a lot of times that is not financial advice, that is not in your best interest. So again, try to tune out the noise the best you can. So on the next slide, one of the most important things that we can control, like we said, some of those levers that we do have the ability to pull. One of the most important determinants of the returns of your portfolio and your long-term success is having the right asset allocation. How much you have in stocks versus how much you have in bonds is going to be the biggest determinant of the overall return of your portfolio and how much volatility you're going to have throughout that time period. So asset allocation is something that's not meant to be static. It's going to change over the course of your plan. As Steve said, the younger you are, the more risk, you really can and should take at that time period until you really need that money, kind of based on your timeline, right? But as we approach retirement and approach different, that was fine. As we approach retirement and approach different areas of our lives where our needs from our portfolio are going to be greater, we have to understand that we're going to need to change that asset allocation and really fine tune it to best improve our plan and generate that sustainable withdrawal rate without putting us into a spot again that we don't want to be in. So it's understanding how much volatility and what expected returns are in different areas of your portfolio, and then finding out how much you need in each one of those areas to really build a portfolio that's going to best fit your plan at this point in time. And like we said, it's going to change over time based on different areas of your life. As we retire from work, come onto retirement, sometimes there's a gap year between when sources of income like Social Security or pensions start. That's going to mean that different rates are going to be coming out of your portfolio, right? So we have to understand what's the best mix for me at this spot in time, and how do I stick on this strategy, until I need to change again, right? So one of the things to kind of think about that is just different ages, right? Different stages, as we said, different areas in our lives where this might make sense to really reevaluate, as we said, and making those minor adjustments where needed, not making drastic financial, decisions, but understanding what changes we need to make. So there's going to be choices along the way and through retirement that are going to help us really determine what we need from our portfolios. So as we're in our 50s, we're coming up on approaching, a lot of times this is where people, are able to save the most in their lives. And catch-up contributions are allowed to retirement plans. We're not able to even withdraw from those retirement plans yet, so we're still in money funding and saving mode. And then, as we transition into retirement, you're able to start taking from your portfolio, and then later on, as we said, as different income sources come available, you'll need to change your mix and really understand how much do I need my portfolio to be growing versus staying constant and less volatile. So a lot of different things that will impact your investment decisions, but as we said, if there's one thing we can count on, it's take a long-term approach and let the market work for you and for your financial plan.
Oh, absolutely. And it's important to set that, again, the investment strategy and plan around these days right here, right? These are all times that are really good to do those check-ins, right? I'm 50. Am I getting close to that? Am I going to retire at 55? Is it 60? Is it 65? What's reasonable? I almost wish we had another line here that showed your spending at each of these ages and your
Right.
savings rate at each of these ages, because that's really what we should be planning around. And then jumping into the last section here, as I mentioned at the very beginning, right, we talked about goal setting. We talked about assessing your current financial situation. We talked about where is your return going to come in, taking a long-term view of investments, because as I mentioned earlier in the presentation, right, we could be retired for 25, 30, 35, 40 years. So we want to plan for that. But it's, again, not about just having assets in retirement. It's about protecting that wealth as well. There's a lot of the hard work. People always ask, how do I retire? And it's not a magic formula. You earn money, you spend less than what you make, and you invest the rest over a long period of time, right? But then the different question is, how do I protect my wealth? And there's coming up with a great investment strategy and diversifying your assets, having a sustainable withdrawal rate. But there's other things you need to account for, right? And taxes are going to be a big one. Again, I think, I forget who says it, but there's two guarantees in life, right? And that's going to be taxes and death. That's, there's taxes. Everyone, if you have an IRA, you have that value minus the tax lien that the IRS has on that value, right? Because that's money you haven't paid taxes on, and the IRS wants their money, right? So, how do you mitigate taxes both now when creating an investment strategy and longer term as you come up with investment withdrawal strategies, right? We want to be efficient with our taxes. Every dollar you don't have to pay in taxes is another dollar you have in your pocket. So how do you build an investment strategy that's efficient? Evaluate, what do we expect taxes now, right? What's your current tax situation? What do you expect that tax situation to be down the road? Those could be two completely different situations depending on what resources you have available to you. And then what's the effectiveness of your strategy, right? There may be strategies that are available to you when you're in your 60s that you want to take advantage of now to help smooth your taxes out 20 years from now, right? Going back to that previous slide where it's got those different ages, there was that age where the IRS requires that you start taking money out of your IRA. So, what do you need to do today at 60 in order to best mitigate those taxes at age 73 or 75, right? Those are the things that you want to plan out for. You want to run a 20 to 40-year tax projection, cash flow plan. Are there going to be major changes to that cash flow? Is there going to be a year where you're going to be spending money to buy that new home, upgrade your current home, sending kids to college? Those would all be things that would dictate a significantly larger withdrawal likely from your portfolio. How is that going to affect your taxes in that year? Does it make sense to spread it out? How are we planning around that, right? Taxes are going to be super important to mitigate along the way. Again, we want to create not just a tax efficient withdrawal strategy, but you want to build out a tax efficient investment plan. Not all accounts are created equal. Some, like your Roth IRA, are tax free, right? You put money in today, you've paid taxes on it. All the dollars that grow are going to be tax free to you as long as you follow the rules, right? So, what do you want in there? You want assets that are going to be high earners, right? Long term. You want those higher expected growth rates. Your IRA, that's money that you haven't paid taxes on. Again, like I just mentioned, there's a tax lien on that account. That account is not fully yours. So there's a tax lien, and some people it's going to be 10, 15, 22, 24, 30%, depending on what your tax situation is. And how do you incorporate that? How do you build that account in a way that you're mitigating future taxes from it? And then you may have a taxable brokerage account, a trust account, a joint account, an individual brokerage account, right? And what assets does it make sense to put in there? Remember, that's an account that it's not tax sheltered, meaning that if that account creates income for you, there is likely going to be some tax liability with that. If you sell assets in there, it's going to create gains. There's going to be some tax liability. So how do you create a portfolio within these buckets tax efficiently? And then how do you withdraw funds from that portfolio tax efficiently? You want to watch out for unusual events in your life, right? Again, selling a home. Are you selling a second home? Is there capital gains associated with that? Selling your investments, right? Timing of when you sell your investments from a tax perspective could have a large impact. Are they long-term capital gains? Are they short-term capital gains? Are we filling up a tax bracket this year because we know we have higher expenses next year, right? Answering those type of things, right? You want to schedule a time to speak with your tax preparer, maybe in off times of the season, right? We've all had the experience of trying to get a hold of our accountant on April 1st. Probably going to be pretty hard, right? They're filing a bunch of tax returns. They're working on those calculators. They're working hard, right? So maybe schedule a time in the off season to talk about what potential strategies are available to reduce my overall tax liability, both now and in the future. You want to look at your pay stub. You want to look at what your current withholdings are, and you want to try to project out, is this going to be similar to what it's going to be in retirement, right? That kind of goes into that expenses and budgeting that we talked about at the beginning. And then you want to ensure your advisor is looking at all tax efficient approaches, right? To help limit surprises, right? We all know that there is going to be a tax liability. I hope we all want to pay our fair share of taxes, the amount that we legally are obligated to pay. But at the same time, we also want to help mitigate surprises along the way. We want to help mitigate a sale of a house affecting your overall tax situation if we could prevent it on the portfolio side. We want all these things to be working in conjunction together to help accomplish financial goals that we established in section 1. with that, again, taxes, both while you're living, while you're retired, while you're working, in your portfolio through your withdrawals, you want to mitigate those. But you also want to make sure what you want happen to your money beyond your life happens, right? You may not know this, but if you don't have a will, the state that you live in has a will for you. And I don't know about you guys, I would much rather prefer to determine where my assets go than have the state do that for me. I always use the example of Prince. It was in the news for a long time right after Prince passed away. He did not have an estate plan, and we're talking about an estate in the tens of millions of dollars. You're probably not going to much care, right? Because you won't be here, but it makes it so much easier for your heirs, right? And if you have a larger estate, there are some things you want to do while you're living to make sure that we're mitigating overall potential estate tax liability. We want to make sure that the right assets are going to the right people, because not all assets, as we saw on the previous slide, are created equal when it comes to spending and taxes, but also with who they go to beyond your life. Certain assets make a lot more sense to give to your children. Other assets make more sense to give to charity, right? But that's something that you want to take a look at all those again, because it's not about what you make, it's what you keep. You worked really hard. You did all the hard work of accumulating assets over your lifetime. You want to make sure that they go and they're transferred in the way that you want them to, so that something doesn't get messed up. And with that, you want to have the right professional team, right? A good professional team is going to help you assess all these different areas, right? You want somebody who's a fiduciary, somebody who's acting in your best interest, somebody who has to disclose any conflicts of interest that exist, right? You want to have a financial advisor, somebody who's going to be the quarterback for all these things, looking at the portfolio, looking at your withdrawal strategy. You want an estate attorney, somebody to draft those documents, somebody who's up to date and knows when a state law changes and know what your documents say, so they can make adjustments for you when that time comes. You want a great CPA. Again, you want somebody who's going to be able to look out, not just file your taxes, but look out and say, hey, how could we improve your tax situation? You're going to want an insurance agent. We've all been getting our property and casualty insurance bills. And if you're anything like me, you've been seeing 15, 17, 25% increases across the board, right? So it's important to have a good insurance agent and that realtor, right? If you're looking to move somewhere a little bit warmer, if you're trying to, just relocate, move closer to the kids, you're going to want a good realtor who knows the market where you're selling and knows the market where you're buying, who could help you facilitate those transfers. A really good professional team is going to be able to mitigate a lot of stress for you and be able to guide you in a way that creates a efficient plan long-term for you.
Right. Let's see. Steve, you want me to take the first one here?
Yeah.
All right. So we got a couple questions. All right. I like this one. Let's see. How do I know how aggressive my portfolio should be today? So, as we talked about on the whole investment section, right? Understanding how aggressive you need your portfolio to be, what allocation you need it to be in, is again really going to be driven by kind of where you are in your timeline and what your plan is really dictating. One of the biggest things I would really focus on is, understanding the timeline of when you're going to need to start distributions from your portfolio. That will really help you understand how much you're going to need in safer assets, right? Because one of the ways we look at safe assets, the bond portion of our portfolio, is really our shock absorber, right? As we go through these volatile markets and periods of stock downturns like we saw, in previous years, we want to ensure that we have enough built up in kind of those lower risk, less volatile assets to be able to fund our living needs and allow those stocks to recover instead of having to sell at market lows and really blow up our portfolios. So I would just say that's really determinant on your timeline and understanding your plan. And that would be the best way to determine really how aggressive you should be from a risk tolerance perspective. And again, like Steve said, however, it depends emotionally as well, how much you can stomach. We don't recommend looking at it on a day-to-day basis, but some people can't, they'll try to back out or they'll try to make a bad decision at a bad time, as we said, if they see those numbers going down. But sometimes we just need to stay put in our seat.
Like I said, right, there's how much financial risk do you need to take in order to accomplish
Right.
your goals, and then how much are you willing to take? So appreciate that, Evan. Got another question here. Should I be saving to a Roth or traditional today? And just like Evan said, that's a very unique personal question, right? You can't give broad sweeping advice or what you should do here or there. It's going to involve running a tax projection given your situation. If you need to spend $60,000 in retirement, that may dictate a different situation, create different opportunities than if you need to spend $200,000 to accomplish your goals in retirement, right? So you need to work with somebody who's going to understand the tax ramifications and understands your goals and your plan, because Roth versus traditional, neither one's right or wrong. It's all relative to your situation and what you expect your taxes to be now and what you expect your taxes to be 10, 15 years from now.
Yeah, well said. Let's see, time for a few more here. Oh, that's a good one. Very relevant for what we're seeing today. Money market is paying such high yields. Why should I invest now? This is actually an extremely common question we are getting from a lot of people right now, as we're seeing we're in a high rate environment where kind of money markets and lower risk assets are paying high rates, right? So it's very easy to stamp out those 4%, 5% returns versus being invested in the market. That I would say be very wary of how much cash and cash equivalent and money market you have in your portfolio versus what you need for your long-term plan. The rates that we're seeing today and the environment that we're in is not going to stay this way. We don't know exactly when rates are going to get cut throughout the year, as we've seen with the Fed in the news. But one thing we do know is that it's not going to stay the same, right? And you need to be able to look into the future and understand, okay, the long-term average of cash equivalent assets and treasury bills has well underperformed what the stock market does. So does this make sense, for when I need this money to be sitting in money market just now versus missing days in the market? So again, I would understand how much you have relative to your portfolio, and just know that, as life changes, cycles will happen. We will not stay in this period forever. So just understand you need to be prepared for the long term.
Awesome. Thank you for that. We have time for one more question. And somebody asked, is there a better way to handle my charitable contributions from a tax perspective? And I know this is redundant, but it's going to depend on your unique situation where you are in life, right? So depending on what your charitable giving desires are, both now and in retirement and beyond your life, there may be situations and there may be tax strategies that you could take advantage of to greatly improve the tax efficiency of your charitable distributions. Again, that's going to be determined by how old you are, how much you're looking to give to retire or give to charities, what types of retirement accounts you have or investment accounts you have, and do you plan on giving during your life and beyond your life, or are you okay with doing one or the other? Answering those questions will help determine what's going to be the best or the most efficient charitable giving strategy for you. Again, I know it's redundant, but it's going to be solely based on your unique situation, what's important to you, and what assets you have available to make those contributions. So again, that's all we had time for questions. Otherwise, enjoy your day.
Yep. Thanks, everyone.